Hello everyone. Try to recall, I discussed the concept of cost of debt and its computation aspect, and I also discussed why it was useful to finance manager or to finance department, how, in what way calculation of cost of capital, cost of debt is helping the organization in making their financial decisions effective. In the same line, next important component of sources of capital may be preference capital. And preference capital is one of the source for medium term to long term. And many companies issuing preference shares in order to raise the money to finance their projects, to finance their different developmental activities or diversification or launching of a new project. So it is very important to you to learn how to calculate cost of preference shares. So in today's session, you will be understanding, you will be knowing what is preference share and why the cost of preference share is important, in what way it can help you in boosting your professional career and to make your financing decisions effectively. To make your financing decisions effective. So cost of preference share capital and its computation will extremely help you. So I'm just continuing. Be with me and listen carefully. I hope you will understand. I will try my level best to explain each and every aspect of computation of cost of preference share capital in very simple way. Now, at the end of this session, you are supposed to learn. So it should be in your mind what you are supposed to learn from this session. Uh, exactly, you will be learning what is cost of preference shares, what are the important components, elements in computation of preference shares. Some numerical examples will also be considered in order to make the concept clear. And you have to practice because these are only some examples from the reference books. You can go through reference books and you can take the numericals part, and further you can read if you find any if you have any doubt, any confusion. Later on in tutorials, we will be interacting with all of you once again. So this is not the only one side presentation from my side. Later on, you will get opportunity to interact with the resource person. Now, as far as cost of preference share is concerned, it is the cost which is paid by the company to all those who contributes or who purchase preference shares for the company. Whosoever is purchasing preference shares, it means they are likely to get certain fixed return, and that return is called dividend. It is very similar to debentures or cost of debt. The only difference, like if you just consider, you are just studying cost of debt, already you have studied. So it is very similar. So you will not face any problem. This is very similar to calculation of debentures or debt instruments. The only difference is, which has been eased in case of computation of cost of preference share, is there is no treatment of tax because dividend is always paid after payment of tax. If you see the financial statements or profit and loss account, interest which is due towards the payment of in towards the interest on debentures, it can be shown as an expense. So after showing expenses on remaining profit, on remaining residual profit, company has to pay tax. So once tax has been paid, remaining profit belongs to shareholders. How this profit is being utilized for reinvestment, utilized in giving dividend, etc. So the only difference between cost of debt and cost of preference is, in that formula you have to write, instead of writing interest, you have to write dividend, which is fixed in nature. Interest was also fixed in nature, and there is no tax treatment because there is no any tax benefit. Why there's no tax benefit? Dividend is always paid after payment of corporate tax by any company. So when we talk about cost of preference share capital, it means the rate of return required by, or you can say rate of return offered by the company to preference shareholders. So whatever is paid or whatever is offered by the company, that will be the cost to the company. So this thing you have to understand properly. Now, certain features are there. These are certain features or some important elements, some important factual information which are important in understanding while calculating the cost of preference capital. Like amount of preference shareholders, whatever amount they get, whatever cost they are paid, it is called dividend. If like you purchase preference share capital of any company, it means you pay certain amount to the company, and what you will get, company will pay you fixed dividend. Just like in case of debentures and bonds, fixed interest is payable. Being preference shareholders, you will be getting fixed rate of dividend. And dividend is not tax deductible. So there will not be any tax treatment. If some information are given in the problems or numerical part regarding tax, so you have not to consider that, because that is just to, that information is mentioned just to confuse you. Tax has already been paid, and after that dividend is paid. So how much dividend is paid, what are the conditions of payment of dividend, that is one thing. But how much will be the cost of using preference share capital, that is the effective cost. So for that, actual calculation will take place. Generally cheaper than equity. Just like in case of debt, amount of interest is fixed. Similarly, in case of preference share capital, amount of dividend is fixed. So preference shareholders normally don't want to take risk in the business. Only equity shareholders want to take risk. So profit is the reward of risk taking. So if you see historically, more returns have been given to equity shareholders instead of for preference shareholders. Lower risk to investors. If you buy as an investor preference share of any company, you are likely to get assured and fixed dividend. You are not contributing, you are not offering yourself to assume the risk. So normally preference share capital carrying low degree of risk. Redeemable in nature. Normally preference shareholders, conceptually we can say redeemable and irredeemable preference shareholders, but normally preference share capitals are redeemable in nature. These are issued for 3 years, for 5 years, for 6 years, like that. So fund has been raised by the company, and after certain period of time it has to be returned, it has to be redeemed. And why calculation of cost of preference share capital, and why knowledge of preference share is important. While calculating the actual cost of capital, actual cost is the weighted average cost of capital. That is weighted average cost of capital. So in case of weighted average cost of capital, certain component of capital may be in the form of debt, maybe in the form of preference, maybe in the form of equity, maybe in the form of retained earning. So composite cost is called the weighted average cost, and weighted average cost is the actual or effective cost of capital of the company. So knowledge of cost of preference share capital will contribute in calculating actual cost of capital or weighted average cost of capital or hurdle rate or minimum rate of return. Assist in financing decisions. So obviously when company has choice of raising money from different sources, so cost is one of the factor. Cost of debt, cost of preference. So each and every source cost will be calculated. So wherever cost is low, it should be, fund should be raised from that particular source. So it will help you. If cost of preference share capital is low and it came to in the knowledge of the company while calculating the cost of preference, so it can be relied, fund can be raised by issue of preference share capital. Evaluates borrowing alternatives. So many alternatives are there, so many choices are there. So we can evaluate, we can judge as the cheapest source, or what should be the component of preferential capital in order to make the capital structure effective and less costly for the company. Now, some of the examples are very similar to which you have used in cost of debt. How it is very similar? Because one thing you have to remember, whether debt instruments are issued or preference share capitals are issued or equity shares are issued, then first thing, as far as calculation of cost is concerned, it will be considered how much is the net proceed, how much amount actually company received, and how much company is paying. Whatever company is paying for using this much of fund, and you multiply it by 100, you will be getting the cost in terms of percentage. So when it is debt, you write interest. When it is equity or preference, we write dividend. So whatever amount of dividend company is paying for using certain amount of fund, multiply by 100, so it will be the cost of preference shares. So in this illustration, you can see different situations are given, like preference shares can also be issued at par, at premium, at discount. Some flotation cost is there when preference shares are issued in the market. Advertisement has to be done. Some underwriters are appointed, merchant bankers are appointed. Some cost is there, cost of issue management. So we call it cost of flotation or cost of issue of securities. So here 20,000 preference shares, 20,000 8% preference shares. In case of debt, in case of preference shares, amount of interest and dividend is shown as prefix. And price of one preference share is 100 rupees. So how much value of preference shares? 20,000 multiplied by 100, so 20 lakh worth of preference shares are issued. Cost of issue is rupees 2 per share. So number of shares are 20,000 multiplied by 2. So it will be 40,000. So flotation cost will be 40,000. Face value or actual value, 20,000 multiplied by 100. That is 20 lakh. 20 lakh. If 20 lakh worth of preference shares are issued at par means company is raising 20 lakh, but flotation cost 40,000 is there. So net amount company is receiving 90 lakh 60,000. On this, what company is paying? Just like this, dividend company is paying. How much dividend company is paying? 8%. 8% company is paying. So total amount was 20 lakh. So 8% will be payable. So 8% on 20 lakh will be 1 lakh 60,000. So this is the amount of dividend as I told you, and this is the net proceed. So 1 lakh 60,000, 1 lakh 60,000 divide by 90 lakh 60,000 multiplied by 100. So the cost of debt in this case will be 8.16%. It's very easy one. Now second condition is there. If it is issued at premium, it means company is receiving more amount than face value. So in this case, net proceed will be face value is 20 lakh and it was issued at 10% discount. It means 20 lakh plus 10% premium. It means 2 lakh. More amount company received, and minus 40,000, that was flotation cost. Minus 40,000 was flotation cost. So 22 lakh minus 40, 21 lakh. Here its total will be 21 lakh. Its total will be 21 lakh 60,000. And how much amount company has to pay? That is dividend fixed in nature, 1 lakh 60,000. So 2 lakh plus 20 lakh plus 2 lakh minus 40. So 160 divided by 21 lakh 60,000 multiplied by 100. So 7 lakh 40,000. So you can see if company is good one and preference shares are issued at premium. So more amount company is receiving but paying the same amount. So denominator is high as compared to here. Denominator is low. When company is not good one, company has to, in order to raise the money, company has to issue preference shares at discount. So here cost will be high. That is 8.16. If company is good one, they can charge premium. So cost of preference share capital is low. When preference shares are issued at 6% discount, so actual value is 20 lakh. So 6% less amount company is receiving. So 20 lakh is the face value of preference share and 6% on 20,000 on 20 lakh. That is 1 lakh 20,000 discount company has given. 6% on this amount. If you calculate, it will be 1 lakh 20,000. So this is the discount offered by the company. Company will not receive this one, but company will pay full dividend. That is 160. Flotation cost is there 40,000. So out of 20 lakh less 1 lakh 20,000 less 40,000, it means 1 lakh 60,000 not received. Only 18 lakh 40,000 has been received. You can say if company is not very good, so company has to give discount in order to get the capital. So in that case, cost of capital will increase. If discount, you can say, if preference shares are issued at discount, it is 8.69. If at par, cost was 8.16. But if company is good one, it is issued at premium, then 7.40. So in this way, uh, cost of preference share capital will be calculated, but cost of preference share, or you can say preference share capital, is redeemable in nature, and that's why cost of redeemable preference shares you have to learn how to calculate. And preference shares can be issued at par, at premium, at discount. Par, premium, and discount. And redeemable issued conditions are this, and for redemption it may be at par, at premium, or at discount. Flotation cost is there. So again, you have to use the same formula just like you have used in case of redeemable debt. The only difference is in case of preference, you will not make that tax treatment, just like in case of debt 1 minus interest, 1 minus t. But here you will write only dividend, no tax treatment, and rest of the things will be the same in the formula. So cost of redeemable preference shares, again, um, just like it can be issued at par, premium, discount, flotation cost is there. So all these things you have to keep in mind. And then uh, cost of preference will be just like annual amount of dividend company will pay. Apart from this, what else company is paying at the time of maturity and net proceed. So difference you will take divide by n for how many number of years preference capital was issued. So it is very similar to calculation of cost of debt. Now with this illustration, this is a comprehensive one. You can understand how to calculate cost of redeemable preference share capital. Suppose there's a company ABC Limited issues 20,000. I have taken the example very similar to cost of debt so that you will not be confused, and you will get a bit confidence because it is very similar except tax treatment is not here. So 20,000, 8% preference shares are issued. The price of one share is 100 each. So in this case, you can say the face value or total amount face value of preference is 20 lakh. So worth of preference share is 20 lakh. And how much dividend, which is annual amount fixed in nature, company has to pay to preference shareholders, that is 8% on that. So this is 20 lakh. So if you calculate 8% of this, it is calculated here. So 1 lakh 60,000 will be the amount of dividend annually company has to pay to preference shareholders. Now next thing you have to find what is net proceed, how much amount actually company received at the time of issue. So value of preference share was 20 lakh. It was issued at 5% premium. 5% premium means you have to calculate 5% of this amount, 20 lakh. It is 1 lakh. It was net proceed. 20 lakh. So this is actually 1 lakh. You can say this is not 10 lakh, this is 1 lakh. This is 1 lakh. So 20 lakh plus 1 lakh additional company will be receiving, and flotation cost is there. It is mentioned somewhere. Flotation cost rupees 2 per share, cost of issue. So 20 lakh is the value of preference share. 2% of this is 40. So how it has been calculated? 2% of 20 lakh is the amount of flotation cost. So actual value 20 lakh plus it was issued at premium, so 21 lakh minus flotation cost. Some expenses are involved in issue of preference share capital. So net amount or net proceed is 20 lakh 60,000. 20 lakh 60,000 is net proceed. And how it was at the time of redemption? What about the maturity value? Redemption value is how much, or maturity value is how much? Now, in this case, after redeemable after 8 years at par. Even if it is not mentioned, for example, at par is not mentioned and no any other condition is mentioned, so you will assume it was redeemed at par. So value was 20 lakh. So exactly at 20 lakh, it was redeemed. So company paid. Actually, company received how much? Net proceed is, so in this case, amount of dividend is 1,60,000, which annually company has to pay. And actually company received 20,60,000, 60,000. And how much amount company paid? 20 lakh. So actually company gained here. Company received this much. Sorry, maturity value is 20 lakh. It is already given here. 1,60,000 is the annual cost. 20 is the maturity value. Company actually paid but received more amount from shareholders by issue of preference shares. So 60,000 company gain. So there will be reduction in total cost. But this gain of 60,000 in 8 years. So if you divide, so that will be 7,500. So in this way, 1,60,000 annual dividend company has to pay, and difference of this 60,000 divided by 8, 7,500 is gain. So there will be reduction in the cost, and the average capital is 20 lakh and 20 lakh 60,000. So in this way, if you subtract 1,52,500 divide by average capital, that is 20 lakh 30,000. So this is very similar, multiplied by 100 is equal to 7.51% is the cost of preference. So if you calculate cost of debt, it is 7.9, cost of preference 7.51. So cost of preference is cheaper. So if you have the knowledge of computation of different sources of capital, it will be easy for you to take the decision. If many alternative or many choices we have for different sources, even for debt fund, loans are available from different banks. Like if you apply loan from any foreign bank or government bank, private banks or rural banks, a little bit slightly you will find effective cost vary. So that effective cost you will compare, and wherever effective cost is low, company should go for it. So this is the point of concern, why you have to learn the computation aspect of different sources of fund. Uh, another example is there here. Another example is given here. Like company issues 12% preference shares of 1,000 rupees. It was issued at 10% premium and redeemable after 10 years at 10% premium. Flotation cost 2% of the sale price. So even if tax information is given, so that information will not be considered while calculating cost of preference share capital. So do remember, if information about corporate tax rate is given in computation of in any problems related to computation of preference share capital, you will not consider, because cost of preferential capital is in the form of dividend, which is fixed in nature, and dividend is always paid after payment of tax. So there will not be any tax treatment. So in this case, what you have to calculate first, you have to know how much is the actual value of how much is the actual value of preference share capital, how much is the maturity value, how much is the net proceed, how much is the flotation cost, etc. You have to incorporate in the formula. So in this way, you can say, uh, suppose 120, when we calculate cost of preference, is equal to dividend, which is fixed in nature. So here, the face value of preference share is 1,000. 12% is the assured of fixed dividend, so it will be 120. So annually company has to pay 120 rupees per preference share. If number of shares are 2,000, 3,000, accordingly, in terms of percentage, cost will remain same, but in terms of amount, the cost can be multiplied by number of shares. So 120. Apart from this, what else company is paying or gaining? If paying, there will be addition in cost. If gaining from reissue and repayment, then there will be reduction in the cost. So you have to find how much is the maturity value. Maturity value is preference shares are redeemable after 10 years at premium of 5%. So price, maturity value, how to find? Maturity value 1000, and it was redeemed at 5% premium. So 5% of this will be 50. So 1050 company is redeeming. But how much amount company received at the time of issue? You have to find net amount received by the company. We call it net proceed. Net proceed means at what price it was sold. 1000 was the price of preference share. It was sold at 10% premium. So sell price was 1000 and 10% premium of this means 100. So it is 1100. So 1000 plus 10% of 1000, its value will be 100. So it will be 1100. Now 1100, it was issued at premium. Some flotation cost is there. Flotation cost is mentioned 2% on sale price. So sale price is 1100. So 2% of this 1100 is 22. So you have to subtract from 1100 minus 22, 1078. So here amount received was maturity value was 1050 at the time of redemption, but actually company received 1078. So less amount company paid to them. Received amount was more, but repayment amount is less. So there's a gain of 22 rupees. You see the difference. But this 22 rupee gain in 10 years. So divide by 10, you will get the gain per year. This is the cost and gain per year divided by the average capital 1050 plus 1078 divided by 2 multiplied by 100. So in this case, it will be 22 divided by 10, that is minus 2.2. So this will be 120 minus 2.2, and we have to take the average of this 1064 multiplied by 100. So that we can do in next slide. So it will be 117.8 divided by 1064 multiplied by 100 is equal to 11.07%. So 11.0%, 07% is the cost of preference share in this case. So just like you have learned cost of calculation of debt, in the same manner, it has been explained in this session how to calculate cost of preference shares and what are the important components of preference shares, why you have to understand preference shareholders getting fixed dividend. Preference shares are normally redeemable in nature. So due to redemption nature of preference share capital, some calculations became a little bit complicated, but not if you understood. If you just practice 2-3 times, it will be easy for you. Only you have to understand the derivation, like you have to find the annual cost which company is paying and how much amount company received to use, how much amount was used by the company. So you have seen the average in case of redemption, maturity value and net proceed. So average capital, this was used by the company, and annual payment, how much company did, that is amount of dividend plus difference between maturity value and net proceed. So this amount is the gross amount for whole number of years, like for 5 years, for 8 years, or for a period for which preferential capital was issued. For example, it was issued for 5 years. You just divide. So you will get annual payable amount by the company to preferential capital. So if you multiply by 100, you will get effective cost of preference share. So in this way, you can calculate cost of preferential capital. You have to practice, and the knowledge of preferential capital, you have understood how to calculate cost of preference shares, cost of equity. You will be learning in next session. Cost of debt you have learned from previous sessions. So This entire knowledge will help you in computing the weighted average cost of capital. And weighted average cost of capital is also one of the benchmark, you can say, cutoff rate for the company, which determine number of important decisions of the company, like capital busting decisions, evaluation of the performance of the company, capital structure decision. So if you just go ahead, you start learning all these things, your career in the field of finance will um, definitely help you in boosting your career. So the kind of knowledge which you are getting, it's all about practice. It's all about how much time you are devoting for this. So this is all in this session where I discussed how to calculate cost of preference share and what are the important elements and components while calculating preferential capital. These components were utilized. So thank you so much. This is all in this session. Thanks for your patience listening.